Today we're going to be discussing risk management and capital protection. So this is the most important part of trading because if you don't get this correct, this is the make or break of anyone as a trader. It doesn't matter how good your technical analysis are, how good of a trader you are. If you're doing ridiculous risks or you don't know how to manage your risks, then the fact is you're going to lose your account. And in all the times that I've lost or I've blown my accounts in the past, when I first started trading, it was all due to bad risk management. If you're not doing your risk management properly, it only takes literally just the one for all of that success and progression just to kind of go down the drain. So with the risk management and capital protection, we're going to be going on five, we're going to be looking over five fundamental parts within this particular module, shall I say. So we're going to be looking at risk to reward ratios and stock placement. Every single trade you do, you want to identify what's the risk, what's the reward, and where do you put your stop loss. We're going to be looking at the position sizing and leverage. So what sort of position sizing should you be having? And if you are going to use leverage, which, as I've said to you in the past, I don't personally use, what does it mean to use leverage? What's the risks involved? What's the rewards involved as well? Market conditions. So, again, whenever we are trading, we need to understand whether we are in a impulsive or a corrective market environment because that has a huge effect in regards to the way we trade and the sort of risks that we identify as well as the rewards and building a realistic growth plan and compounding. So make sure all of your expectations are set, it's important for you to be realistic with what you can make when you are trading. Some people have really unrealistic expectations, and some people put a lot of pressure on themselves. And by putting all of that pressure on yourselves, what's happening in return is that you're going to end up trying to overtrade in order to hit a certain amount of money over your next 12-month period. So it's very important for us to be realistic about what can be gained and how much money can be generated. And in terms of mindset, as we all know, we always end with a mindset piece because trading and mindset goes hand in hand. And a lot of people who do lose money is simply because their mindset also isn't in the right place. So, understanding risk management. So, before we think about profits and strategy, the main goal is simple. It's really to try to stay in the game as long as possible to win. So it's about consistency. It's not about taking out big wins over a period of a month and flipping your account 100%. It's all about compounding and being consistent and having a good expectation and knowing that when you are doing your risk to reward, you're being sensible with it, which will in return allow you to continue to survive in the markets, even if you do have a couple of bad trades. So with risk management is really what keeps us all in the game. So it's so important for you to plan your risk before your reward. And it's so important for you to kind of just be on your job and make sure you're protecting your capital. In terms of the emotional control, so the emotional control really starts with the position. If you're risking, if we have what's called a trader's tolerance. If your risk tolerance is high, then it means that you're able to kind of put a lot more risk into a trade, knowing that you can tolerate. If your risk tolerance is low, it means that ideally or technically speaking, you should be risking a lot less. I'll give you an example. My risk tolerance as a trader is quite high. Because I've been in the markets for such a long period of time, I can get away with putting on more risk per trade. Most of you guys who are just starting off on your trading journey, you won't be able to tolerate as much risk as me simply because you're not comfortable with the markets yet. And it's in being comfortable with the markets and being in the markets for a period of time and building up a relationship with whatever you're trading. All of these things will have an effect on your risk tolerance and how you feel comfortable trading whenever you do go into a certain trade. So as we do go into the lesson, I'm going to show you within these slides that what I may risk is going to be different to what some of you may risk. It's also very important for me to state that regardless of how high your risk tolerance is, you need to still be sensible with how much you're risking per trade. Just because I've got a high risk tolerance, it doesn't mean I'm going to risk 50% of my account. That's just stupid. I still need to be sensible with whatever I put on per trade. And also, you want to focus on the process, not the perfection. So the goal isn't to win every single trade. I did have a period of time where every single trade I put on, I felt like visually it had to result in green or blue money. There was a period of time where if I put on 10 trades and two of them I saw red money, it had a psychological effect on me, which, and that's because I was going for perfection. And in going for the perfection, because I wasn't happy with getting 10 out of 10, I would overtrade or I would try to look for an opportunity to get that 10 out of 10, which made me instill really bad habits. This was at a time in the past in which I was trading. So it's important to know that if you do see some red or some losses on your chart, then it's fine. And as long as your risk management is done correctly, then you're always going to be winning by the end of the 12 months. So it's not always about having a win-win-win trade. And then risk management isn't just about numbers, it's about confidence. And again, you can't control the outcome of the market, but you can control your exposure. So the market's going to do what it's going to do. But the one thing that we can control is whether it goes up or it goes out of our favor. The fact is, the risk that we've done accordingly and this and how sensible we've been through the risk that we've put on, we can feel comfortable in the fact that if it does go against us, it's not going to shaft the whole account or it's not going to give us a bad experience, whether it may be psychological or financial. So understanding that you can't control the outcome, but you can control the exposure, what you expose yourself to in the markets is what really separates professional traders from gamblers. There's a lot of people, there's a reason why they say, I think they say there's only 5%, I think it's got a bit higher, only 5 or 8% of people are successful in the markets. And generally speaking, a lot of people can trade. They all trade the same way. They trade with the same amount of technical analysis. We're all open. We've all been exposed to the same amount of insight. The only difference is that some people, with that insight they've been exposed to, they've risked more than 50% of their account, whereas others have decided to only risk between 3 to 5% of their account, which allows them to stay in again, regardless of their wins or their losses. And that's how you should be taking in risk management whenever you're trading. So risk to reward and stock placement. So I'm going to go on a chart. Now, ideally, if any of you guys have a chart in front of you, it would be good for you to open this up and copy what I'm doing. If you can copy what I'm doing, then what it means is that we're now taking the theoretical learning into practical learning. And that's what I really want you guys to try to grasp. So if you guys want me to wait a minute whilst you open your charts, that's fine. I'll wait. If you've got charts open in front of you already, brilliant, that's good. Um, I'll give it probably about a minute just for you lot to open your charts, whether it's on your mobile. Ideally, if you can open it on your desktop, that would be great, but mobile should suffice as well. I'm going to share my screen in the meantime. So I'm hoping some of you got your charts open. Again, you're going to see everything doing is well, it's a recorded session anyway, so you can just go back to it and refer to it and copy it at a later stage. But so risk to reward ratio and stock placement. Now, it's great us being able to see opportunities. It's great for us to be able to say, oh, this is going to go up and this is going to go down, and for it to go in the direction in which it's going to go. But how do we actually take advantage of that in order to make money? That's what trading is all about. How do we actually take the theoretical learning and the technical analysis and put it into practice to a point where we're now making money? So when it comes to risk to reward ratios, I would advise each and every one of you who are just starting to trade, only risk 1 to 3% of your trading account. Do not risk any more. Risk 1 to 3%. The reason why I say that is because you're going to make stupid decisions. Even though we do have a good level of support within this group, and as it continues to grow, there will be more experienced people supporting the people who are just beginning. The ones who are just beginning, I tell you, sometimes I went into a trade, I identified a trade, I went to what I believed was a buy, and I accidentally pressed sell. Now you might be thinking that is a stupid thing to do. I'm telling you from now, if you're rushing and you want to catch the trade when you see the break, and you're just becoming familiar with your broker, there is a possibility that you might do something stupid like that. When I was learning about what pound per point meant or lot size, I was putting on a lot size of like 10 lots, thinking that that was only going to equate to 3% of my account. not realizing those 10 lots was actually equating to 30% of my account. So I went into a trade, not realizing that when it was going against me or in my favor, I was getting a hell of a lot more money than I anticipated, or I was going into drawdown a lot more sooner than I anticipated. So the reason why I'm saying these examples is because, there's still a lot more of a journey for you lot to take. So it's important that you guys minimize your risk to make sure that if you do make mistakes, it's not going to bite you in the arse as much as it would have been if you was doing, let's just say, 5% risk or whatnot. And also, more importantly, you are going to be left to be independent to some degree as well. So sometimes you guys are going to identify trades. You're going to go back to your technical analysis and you're just going to take it, maybe without even putting it in a group first. So if you are going to do that, knowing that you're not a veteran trader and you've only started trading, just be patient with yourself. There's always time to make money. So I would say the beginners do 1 to 3% maximum. As if you're experienced, you've built up a relationship, you know what you're doing, then I can say you can do 5%. Considering your hit ratio is really good as well. So if you've got a hit ratio where you know that out of every 10 trades, you're doing 8 successful trades, then that's a very good hit ratio. So if you are doing those sort of returns, then again, 5%, in my opinion, remember there's no right or wrong here. There's only risky or less riskier. But from my experience and the way I've been trading, that will allow you to generate a good amount of profit over a consistent period of time and will also allow you to be quite safe in the profits that you're generating as well. So, as you become more consistent and you're hitting 8 out of 10, cool, no problem, do 5. But the higher your win ratio, the more flexibility you have. So never let that lead to being overconfident. Just allow that to make you realize that you're going to be in a good position by the end of next year, is what I'd say. So remember, a low hit ratio means you need to reduce your risk. And then as you become more consistent, you start to increase it. So never risk more just because you want to make it back as well. So the reason why I say that is because sometimes what happens is that when we have a losing trade, we start to get what's called revenge trading. And then what we say to ourselves is that, okay, I've lost 3% of my account. And in our minds, when we see another opportunity that presents itself, so I'll share the chart. So for instance, you guys sell it here. You see this as a sell. You go into your position to sell it. It goes back up again. And let's just say, unfortunately, you lose 3% because that's your risk ratio. What a lot of traders start to do, they say, okay, it's now doing another high. When it breaks here, because I lost my 3% here, and I believe it's definitely going to go down now, I'm now going to risk 5% or 8% because really psychologically, I'm trying to get back the unnecessarily losses that I took there. Do not do that. It's not necessary. When you start trying to kind of cheat yourself and break your rules every now and then, depending on where the market is, sometimes it will go in your favor, yes. But I guarantee you, and I'm telling you this from experience, I've been in the market for nearly 15 years now. I'm letting you know that might work the first time, it might work the second time, it might even work the third and the fourth time. But there's going to be one time where you increase your risk to 10% or 15% because you're trying to get back your losses and you think you know what it's going to do, and it's going to bite you in your ass. And you're going to end up literally going into even more drawdown than what was necessary in the first place. So always stay disciplined regardless of how amazing an opportunity looks, always stick to your percentages. If you're starting and you can see a trade that looks like it's going to do a 5 to 1 and it's got 99% likelihood of going in the direction that you've seen, do 3%. Don't bring it to 6%, regardless of you know, how I don't know how appealing that looks for you at the time. So please just listen to me, take my wisdom on board when it comes to that. It will save a lot of heartache in the future. So risk per trade. So when it comes to risk per trade, guys, we want to make sure that we are risking. Guys, take a screenshot of if you can take a screenshot of this whilst I'm talking, please do it because I'm going to switch to the charts again. And I want you to kind of be able to flicker or reference this information on this particular slide whilst I'm showing my charts because it's all going to be very important. So generally speaking, you want to do a minimum, generally speaking, of a 1 to 2. So when I say that is that if you are risking £1 of your per trade, you want to see yourself gaining a minimum of £2. So that's a 1 to 2. Some traders, if they're risking £1, they do try to say to themselves that a 1 to 1 is good enough. So when you're in a markets at any given time, depending on the size of your account, you could be risking anything from £30 to £500 to maybe even a couple of grand per trade. It all depends on the size of your account. But what I would always advise you guys is that if you're identifying a minimum of a 2 to 1, what that means is that if the trade doesn't go according to exactly how you thought it would go, the minimum you're probably going to get in a worst case scenario is a 1 to 1. But now, if psychologically you're identifying a 1 to 1, if that trade doesn't hit, if you're risking £30 for a £30 gain, if it doesn't get to the £30 gain and it goes beyond that, you're now probably gonna what? You're risking £30 for the sake of maybe gaining £15. It doesn't make any sense. It's always about making sure that you identify opportunities that are good and it makes sense to a point where you're not going to lose unnecessary money. So just going, so I did ask you guys to take a screenshot of this of those points because I'm going to go back to the chart now. So on TradingView, it's got some really good tools which will allow you to identify exactly how much you're risking and what your reward is. If you can see on my side panel here, there's this option here, which is called a long position or short position. In fact, let me open trade it 1 second. I'm going to open a different chart. So within this tool here, you've got these tools. You're going to be using this every single time you go into a trade. This is what you ideally should be using. If you're going to buy something, you're going to open this long position tool. And if you're going to sell something, you want to open the short position tool. So right now, as a lot of you are aware, we've done some analysis for US 30, right? So we're saying that I'm anticipating for us to get a sell, whether it's corrective or impulsive, we'll see when it happens. So what I'm going to go, now that I'm looking to sell it, I'm going to open the short position tool. When I click on a short position and I click on the chart, this is exactly how it will look. So within the short position tool, what you are doing, you really want to identify what are you risking in regards to the money for your trade in return for the profits. That's pretty much what you're doing for this particular tool. You want to understand what's your risk, what's your reward. So if we look here, if I want to sell this, as I said to you guys, ideally you want to do a minimum of a 2 to 1. This here says where the stop is. So if the chart goes beyond this line, let's just say it kept going higher, it will stop me out. That's when it will take my money, it will take out of a position. This red area, this green area here indicates that if it continues to go down, that's where it's showing you how much money or how much profits you're going to take away from the chart. So if I click on it, what it's saying here, if I move my stop, let's just say 400 points, right? Hopefully you guys can see that. I've moved my stop so it says 400 points. If I've got my target and I say that I want this to be a minimum of a 1 to 1, what I'm saying is that I'm risking 400 points for the sake of gaining 400 points. Now, if a trade looks very probable to you guys, I'm not going to tell you not to take it. I'm just simply telling you that ideally we want to identify a minimum of a 2 to 1. But if it looks good, then of course take it. Just make sure it's within your 3% risk, your 1 to 3%. So now that I've used this tool, I will now say, okay, my stop loss is going to be here, meaning I'm risking 400 points. I want a minimum of a 2 to 1, meaning the minimum reward I want is 800 points. So if I'm risking 400 points, I'm in the same breath saying that I want to take away a reward of 800 points, which is technically a good trade, genuinely a good trade. But remember, your points need to align with your pattern identification. It needs to align with your exit points. It needs to align with your targets. So whatever you're saying you want to risk and whatever you're saying you want to gain, it always needs to align with your technical analysis. So this is how I trade. I will say, okay, I believe US 30 is going to go down to here. That's its first target. Once I believe it's not going to go any higher than this point here. So I will get my tool and I will bring my tool to that target. So I will say that's the target, which is where I believe it's going to go to. I'll say this is my risk that I'm going to do for this particular trade. And as you guys can see, this tool automatically identifies what your risk to reward ratio is going to be based on your technical analysis. So based off my analysis, I'm now what it's basically saying is that I've got a risk to reward ratio of 3. So if I'm going to potentially lose 276 points, let's just say that's £1 a point. What that means is that I'm going to triple that if it does go in my favor. So 276 points tripled is going to turn into a target of 830 points. So I would genuinely say, if any of you lot said, oh, this is a trade I want to take, I'd say that's actually a good trade. That's a very, very good trade. So take it. So now, if I'm saying that for this trade, let's just say we scale into a smaller time frame. If I think, let's just say I've got a trend line here and I want to take the trade to this trend line here, but it could potentially go all the way back above this point here. So this is my reward. This is the risk. Guys, I'd like any of you to put in the chat. Do you think that's a good trade or a bad trade? Based on the reward that I would get to this trend line here and based on the risk that where it could potentially go back up to. Would you say that's a good trade or a bad trade?
Trade.
Yeah, 100%. It's a bad and James, what I'd like to ask you, I'd like to get your bit of your analysis here. Why would you say this is a bad trade?
Well, because I don't know the exact points, but it looks like you're risking, let's just say 3 to 1. So risk. So it's a 3 to 1. So basically, let's split into 4 parts. You get, let's say 100% is full. Sorry, I don't know how to probably explain this, but
Yeah.
if it hits your take profit, you gain, let's say 25%. But if it hits your stop loss, you'll lose 75%.
100%, exactly. Spot on. Thank you, James. Thank you. So that's exactly right. So what James said, we're going to show it with this tool, which makes our life a hell of a lot more easier for us. Remember, back in the day, we didn't have these tools accessible before TradingView was out. People literally had to manually type it in their calculator to understand what they could potentially lose in comparison to what they could potentially win. So if we're saying, so we're taking a short position. So that's our target there. And this is where our potential stop is going to be. As you can see here, the risk for this trade is a 0.30. It's not even a 1-to-1. It's a 0.18. I said to you guys, you need to be doing an absolute, ideally, you want to be doing a minimum of a 2-to-1, but your absolute minimum should be a 1-to-1, meaning if you're risking 30, well, in this case, 324 points, you should be gaining at least 324 points. So as you guys can see here, if any of you said, oh, Bentley, I've identified this trade, I think it's definitely going to go down, but I'm going to have to risk a lot in terms of my stop loss. What I would say to you guys is it doesn't really matter how far down you think that's going to go. Just don't take it. It's pointless. Like why try to pinch, minimal profits from the markets, knowing that if it did want to go against you, or if it did go against you, it's going to completely just put you in a bad predicament. The idea, as I said to you from the very beginning of this call, is to make sure we can stay in the markets as long as possible. The less losing trades we take, and the better our risk management is, the longer we can stay in, the more profitable we'll be, which will in return put money in our pockets year in, year out. So don't take trades like this, is what I'm basically saying. It's not worthwhile. Do any of you have any questions based on what I'm saying? No? Everything clear for all of you, I'm assuming? Crystal clear? Cool. If you're clear on this, let's move on. So that's the tools. You've got your buy, your long position, which is a buy, and your short position tool, which is a sell. Always use that before you go into any single trade.
Is this only a bad trade because you're going for the short, whereas if you're going for the buyback up, it's not as bad?
Well, what would make it a good or a bad trade is the direction in which you believe it's going to go to. So if we can see it's going to break to the upside, then already we're warranting ourselves to get involved in the trade. But if we believe it's going to break to the upside, but there's also a higher probability of it going back down, and if it does go back down, we're due to lose a lot more than we are to gain, then even though it's a successful trade, the risk in which it entails us going into this trade just doesn't make any sense. So it's the same kind of scenario as what we'd say by pick your battles. So not every battle needs to be fought. The same thing with trading. Not every trade needs to be entered. What you guys need to get into a habit of doing is saying, I know where that's going to go, and it will go there, but I don't need to be in it simply because the risk of that trade is going to outweigh the reward. That's a very common. I'd say that is probably one of the main reasons why traders end up blowing their account because they see, oh, it's going to go down. Okay, cool. I'm risking 5 times more than what I'm due to get in terms of reward, but I'm still going to go in it only because I can see where it's definitely going to go. I've got to a point now where I'm just like, look, I can see that's going to go down, but why am I going to potentially risk £100 of my account to gain £20 when by the time it goes back up again, I can basically now gain £100 with risking £20. So it's all about just asking yourself, what are you prepared to take advantage of and put your account to risk for?
That makes sense.
Cool. So when it comes to your risk to reward ratio, so let's just conclude it. So your minimum risk to reward ratio should genuinely be your 2 to 1. So if you're risking £50, you should be gaining £100. If you're doing a 1 to 1, fine, but identify your bigger ones. Your stop should be placed beyond the structure. So if you are going into a trade and if you are risking a certain amount, just make sure that your stops are outside of the structure of the trade, as I just showed you guys. So go back to trade and view again. So if you've got a structure here, or let's just say you've identified this correction, for instance. Within this correction that you've identified, this is the lowest point of the correction. If you can see that this is going to go up, you want to make sure that your stop loss is outside of that structure. So let's just say you're buying here and you believe this is a target for this trade. Your target's going to look like that. Your stop loss has to be, remember, your stop loss has to be outside of the correction. The reason why it has to be outside of the correction is because even though it breaks out, there's a huge probability or possibility that it can go back in again before it goes all the way back out. So for that reason, make sure that your stop loss always goes outside of your structure. So this is where your stop loss is going to be. This is your target. You should see your risk to reward. So you're saying that it's got a 1.67 R to R, which generally means that it's a decent trade. It's just above a 1 to 1, but just below just below a 2. So that's how you should always trade. Stop loss outside of the pattern or the correction, and identify your target, which might be to your trend line, it might be to your Fibonacci line, it might be to a Fibonacci extension. But always put your stop outside of the structure. Very, very important. With your stop loss being outside of the structure, if it's inside, it just basically means your trade is invalidated. Don't try to move your stop within just to make you feel better. Because if you do something like that, and let's just say it broke it and then it went back inside again, as you guys can see here, if it decided to go any further down than this point there, it would have taken you out. So always make sure it's outside of the structure or it's outside of the break of your trend line. Remember, this structure which you're looking at is the hour time frame. You might see smaller structures on a 15-minute time frame. So make sure that whatever structure you're identifying is always going to be coherent with your longer degrees as well as your shorter degrees. So always bear that in mind. And always try to make sure that you're going on your technical analysis. Don't go on your emotions. Don't go on the fact that, oh, I can clearly see where it's going to go, so therefore I'm going to take it. Always rely on your technicals and make sure you're doing your equations and your calculations, which is all dependent on what you can see within your correction and your impulse. So let the structure and the wave count dictate your stop. Yep. And if you want even more of a breathing room, let's just say you want to bring it down to here, for instance, just so you can be more safe in your trade, that would mean that you need to put on a less pound per point. So if you're going to put on a less pound per point, of course, what that means is that by the time it does come up here, your profits aren't going to be as big as what it would be if your stop loss was a bit tighter. So if you've got a tighter stop loss, you can put on more pound per point. If you've got a wider stop loss, you have to put on less pound per point. But as regardless of whether you're putting on more or less, everything needs to go back to you risking the overall amount of 1 to 3%. Again, we've got access to these documents, so all of you guys can just make sure you always refer to it every time you're looking at your trades. So position size and leverage. So now we're going to go over to position size. So in terms of your position size, you always want to make sure, well, okay, let's not even hit leverage first. So position size is how you really convert your risk into numbers. So the formula for your position size is basically the account times the percentage of the risk divided by the stop and the pip value. So this is an example here. So if you have 1 grand in your account and you're risking 2%, that means you're only risking £20. So whatever trade any of you go into, you're not going to risk anything more than £20 because that £20 is going to equate to the 2% of your trading account. Now, this is where it's going to get a bit tricky. We're going to go back to the charts again. So we know we're only risking £20, which is 2%. We have a stop loss of, we'll put in any direction. Our stop is now, let's just say, 100-point stop. Let's just say for this particular trade we have to put our stop loss, which goes beyond our correction. So we know that we have to have a minimum of 100 stop to go into this trade. Within that 100 stop, we can only risk £20. So in order to understand how much we can put on for that trade in terms of the lot size or the pip size, we now need to divide 100 by 20. So if you take out your calculator, we've got 100 stop. Sorry, divide £20 by 100, sorry. So we can only risk 20% of our account, £20 of our account. Remember, £20 equates to 2%. We now need to ask ourselves, if our stop loss is 100 points, how much pounds per point am I now able to put on for to warrant that stop loss or lot size? So we want to divide 20, which is the full amount, by 100, which equals 0.20. So what we are now saying is that we can only risk 20 pence for this particular trade. We can only put on 20p per point, which in the terms of lot sizes is 0.2 lots. So I'm going to take you to Vantage, the broker, because if a lot of you have already signed up to Vantage, this is the broker that you're going to be using to take in your trades. So it's important that you can see and realize how Vantage operates whilst you are taking your trades. Right. So on Vantage, they have a desktop platform and they also have a mobile platform as well. I generally mix between the two. The mobile is easier to understand. I was actually going to show you the example on the mobile, but unfortunately, because the markets are closed today, it's not going to allow me to do a live example. But I can show you on the desktop. One sec. So this is how it looks on the desktop platform. So if we're going to put on a trade, we are doing 100. We know that we need a stop loss of 100 pips or 100 points. We can only risk 2% of that account, which means that the stop loss or the 100 pips is going to equate to approximately 0.20 well 20 pence per pip. What we want to do, we want to go to stop loss. So click on your stop loss first. That's what you want to do. If we're going to buy it, and this is a great thing about Vantage. So what it does, we can say we only want to risk 3%. So by risking 3%, it automatically gives us the calculation of how much lots we're going to be using for the particular trade. So as you can see here, I've put on the stop loss. If I increase the pips, so let's just say I want to risk 5%, you can see that the dollar or the risk in terms of dollars or pounds increases because now I've increased the percentage of my risk. The lots, which also increases the lot size as well. If I'm risking 1%, as you can see, it only allows me to do 11 lots. The risk in terms of dollars is now only £8. But you always need to put your stop loss before anything else. So when you're going into a trade, always put in a stop loss and then always put in your percentage, what you want to risk for the particular trade. Once you've put in your percentage, it basically tells you and calculates how much dollars that you're going to get per pip that it moves in your favor. So if it goes 5 pips in your favor times £26.41 by 5, you're basically looking about 130, for example. So if you're increasing your risk to 5% and that moves 5 pips in your favor, then 44 times 5, you're now looking at probably about $230 for that particular trade. So that's the great thing about Vantage. And meant to be honest with you, a lot of the modern trading platforms do that for you now. It's not something that we need to do manually, but just make sure that you're always doing your stop loss before you do anything else. With the spread, whenever you guys are going into a trade, you will be charged to go into a trade, and that's basically how brokers make their money. So I think, did we do this? I believe we done this on the first call. I'm not entirely sure, but let me just kind of bring it to your attention again. So if you are going into every single instrument has a different spread. So it's got a different difference. Some spreads might be 1 pip, some might be 5 pips, some might even be 0.2 pips or zero point 0.0 pips. But with the spread, if it's 5 pips and you're risking 44 dollars per point, or your lot size is 59 lots, it's basically going to multiply that by the spread. So automatically, when you go into a trade, you're automatically going to be in minus 5 pips, which will be minus 40 that times 5, or minus 59 lots times 5 as well. So that's a very, very important thing for you guys to consider, that just as soon as you press that buy button or that sell button, you're not going to be in profit straight away. It's going to have to go, at least in this case, 5 pips in your favor before you even come to break even. Then once it goes beyond those 5 pips, then you will start seeing the percentages and the profits come into play. So yeah, thank you for that. Yeah, that is very important for you to consider. And that's why some people choose different brokers for different reasons, because some brokers have a tighter spread, where let's just say in this case scenario, this may potentially be 2, whereas other brokers have a wider spread where that may be 10. And of course, if you're going to go into a trade that's got a massive spread, you don't really want to be, as soon as you press the buy or the sell button, be sitting in minus 10 pips. Ideally, you want the spread to be as tight as possible. the thing is, all of you are it's going to be so much more easier once you actually go into the broker and press the button. So this is why I advise you from now onwards to have your demo account and actually start taking trades on your demo account. Because when you start taking it, you can actually see how everything functions. Me explaining it to you, there's only so much understanding that you're going to gain from the explanation. So it's very important at this moment of time for all of you lot to be a lot more practical and be more proactive when it comes to actually putting on demo trades. Then it will all just make sense. Okay, so before I jump into the next slide, part of this is leverage. So with leverage, a lot of brokers do offer leverage, and leverage can be really good. Myself personally, I do remember we had the call on this a couple of weeks back as well in regards to the benefits of using leverage. So what you'll find with Vantage and many other brokers is that they do give you the option to use leverage, which means, and their leverage can really fluctuate anything from 1 to 10 or 1 to 100 to even 1 to 500 and 1 to 600 in some cases as well. What that basically means here, as you guys can see, is that a 1 to 100 leverage basically means that if you have a pound that basically controls £100 exposure. So if you put on let's just say you've got a lot size and your lot size is 1 and you're using 100 to 1 leverage, that lot size now automatically controls, or the value of that lot size will now be 100, not 1. So what that means is that if you wasn't using leverage, you as we clearly saw, you went into a trade, you done £1 a point, it moved 40 points in your favor, you'd make 40 pounds. With the leverage, that pound a point now is now equal to £100 a point. So if that moved in your favor 40 points, with the leverage of that now being equal to £100 a point, that means that you will basically be getting 4 grand, pretty much, from that trade. So that's how leverage works. Now, as appealing as that sounds, it's also very, very important for us to understand that with a lot of money that we can potentially make in the markets also comes a lot more risk. So yes, you can do 100 to 1 leverage. You can do 500 to 1 as well. But what happens if that goes against you? So the value of that pound or point has now gone to 100, gives you more reward. If that goes against you, 40 points, you're now due to risk the same value as well as you was due to as well as you was due to gain. So if that goes against you for 40 points, knowing that you've used the leverage of 100 to 1, which means the value of that pound is now £100, you're now potentially losing 4 grand in your account if that goes against you. So it's so important for any one of you guys to really understand that whilst many of you can use the leverage, it needs to be in accordance and conjunction to the risk that you're putting on per trade. So if you're putting on a 3% risk, you're using leverage based on a 3% risk. Yes, it might equate to be more than 3% by the time you lose money, but if you're doing it correctly, then of course, happy days. But myself personally, I don't use leverage. I've never used leverage. I've only used my own funds. If I'm doing 3%, then I stick to that 3% based on my percentage calculator. And as far as I'm concerned, if I want to get up to a point where I'm putting on £100 a point or £1,000 a point, I would just need to have a certain amount of patience to build my account to that value to a point where I can now put on that amount per point. I don't see the point in rushing it. And that's just for me. Again, some of you guys might be inclined to use leverage. I'm not going to tell you not to use it. But what I will say is just that be aware of the money that you can lose if it doesn't go in your favor. So that's just definitely something to consider. So when it comes to the markets as well now, as we all know, a lot of how we trade is based on basically impulse and corrections, right? So we whenever it's a correction, we're looking for impulse, and the idea is that we use the correction as an opportunity to get in and take advantage of the impulse. That's what we do. But what might look corrective on a daily could actually be impulsive on a 1 hour. What might look corrective on a 4 hour can actually provide us with some impulsive moves on the 15-minute time frame. So with that being said, it's very important for us to really just kind of understand our strategies and the way in which we're going to trade, depending on what market that we're currently in. So I'm going to share the charts again. So as you guys know, the market's moving two phases. Let's go to our US 30. And with those two phases, as I just said, we're going to dictate how we trade. So if we're trading within this correction here, we've really got to understand that whatever happens within this correction is going to be short-lived. So when I said to you guys, the minimum, absolute minimum that you should be taking is a 1-to-1, you could actually use that to your advantage and take 1-to-ones within a corrective structure, because you know that by the time it goes to the downside, it's going to go back up again. By the time it goes back up, it's going to go down again. So with that sort of price action that you're seeing there, that's where I can say, that's what I'd say to you guys, okay, it might be fair or okay for you to actually go for a minimum of the 1-to-1. Now, as you guys know, the reason why I say that is because it's choppy. By the time you get your free count down, you're going to get your free count up again, and you know it's going to be really, really limited in terms of the follow through, which means that your risk to rewards, of course, is going to be smaller, and you're going to be prone to false breakouts. Now, if you're going in an impulsive move, that's where I'd say to you guys, you can and should be identifying targets that's a minimum of a 2-to-1. So remember, if it's an impulse, it means that your rewards, your expectation is that your rewards are going to be bigger and your risk is going to be smaller. If it's a correction, your risk is going to be just as big as your rewards. So that's one very important thing for you to consider whenever you're trading. So always ask yourself before you identify what should be your minimum R to R, what sort of environment am I trading in? And then that will dictate whether you should take small profits or try to stay in trades for a longer period of time to take bigger profits. So when you are in an impulsive move, what you can do, which is really good, you can trail your stop loss. So when you start to trail your stop loss, what that basically means is that once it breaks out of a certain point and you've cleared, let's just say, 100-point threshold, now that you can confirm that you're in an impulsive move, what you can do is move your stop higher. So to a point where if it does go back against you again, you're not going to lose any money because it's gone above your threshold. So with that, it's very easy for you to continue to scale into your trade, and it's easy for you to basically not even just minimize your risk, but completely eliminate any sort of risk that you had for a particular trade. So if I'm in this trade and it's broken out of this area here, it's done, this has gone up again. Let's remove this top line here. If I believe that this is now going to continue to go higher, let's just say my initial stop loss was here when I went into the trade. So that's my reward. That was my initial stop. The moment it's gone up here, what I can do now, I can remove my stop loss, bring my stop loss to break even, meaning that regardless of what happens, I'm not going to lose any money now, and I'll just keep trailing it. So every time it keeps going higher and higher and higher, whereas if it stopped me out here, it will stop me at break even. If I trail my stop loss, just believe this point here, and it keeps going higher again, what that means is that I'm now banking, certified banking, this amount of points, meaning that regardless of what happens in the trade, I'm always going to win. Of course, we want to maximize our gains and our rewards, but the whole idea here is that we keep trading. We keep trading. So if it goes up again, we'll trail our stop loss again. So meaning that if it comes all the way back down again, by the time it stops us out here, we've already banked all of these profits here. So that's where you can kind of start being smart. But the only time you can start trading like that is if you are trading in an impulsive market environment. You can't trade like that when you're trading within corrections. Why? Because as you guys can see here, the moment it goes up again, the likelihood is that it's going to go down. So of course, there's no stop loss to trail if you know that we're still due an impulsive move or an impulsive breakout at a later stage. So just be aware of that and make sure you're mindful of how you trail your stops when you're in a different market environment. So you can have a 1 to 5 in a impulsive wave count, but it will be a 1 to 1 in a corrective wave scenario. Now, this is really important. So it's very important for us to set our expectations as we move forward in terms of how we can grow our account. I said to you guys, I posted something in a group just the other day. I said I'm going to show you how to grow your trading account from 1K to 3K over a period of 12 months, which in return, that's a 200% growth. Now, the reason why I'm able to do that is because I'm aiming for a minimum of 10% growth per month. And also, I know to myself that I'm going to be compounding that as well. So I would always advise all of you to aim for a minimum of 10% or 30% a quarter. The reason why I'd say probably do it over a quarterly basis rather than a monthly basis is because the markets, some months it doesn't provide you with the best opportunities. So for instance, during the Christmas period, it's generally known that the market slows down quite a lot. Now, if you're putting pressure on yourself saying that you need to generate 10% every single month, what happens if December comes and you're not generating 10%? You're going to feel demotivated. You're probably going to start over trading. You're going to start trying to identify trades that wasn't there in the first place. Whereas if you say to yourself, I need to make 30% every quarter, what you are essentially saying is that during the months of October and November, if I make about 15% during those 2 months, and I only do, wait, 15%. No, so if I make in total 15, let's just say 12%, 12%. So 12% for October, 12% for November. What you're simply saying is that if I only do 6% in December, you're still making your 30%. So that's why psychologically it's always better to set goals from a quarterly standpoint and then reverse engineer that and work yourself down from month to month. But know to yourself that if 1 month you only get 5%, it's not a big deal because you still got your other 2 months where you can generate about 13% or 14% each for those 2 months. So always kind of do that to relieve yourself of the pressure, which also aligns with the market cycles. Now, what I want you guys to go on is what's called the compound calculator. I'm going to send the link in the group. I want you guys to go on this compound calculator so you can see exactly how much money that you can make if you take on board this kind of 10% per month strategy whilst also compounding as well. And again, guys, I want you to use your phones, or if you do have a separate device, and just so you can see exactly what this does and how powerful it is. With the compound calculator, this is how I set my goals with trading. I basically use this and I use it to help me establish kind of what I potentially will be walking away with each year in terms of annual growth. So what I want you lot to do first is make sure that you set your currency to the pound. And if you guys are, let's just say you've got an initial investment of £1,000, what we are saying, remember, based on the projections of 10% a month, we want to set that to monthly and we want to put that on 10%. We're not depositing anything, so we're going to leave it as none. So there's not going to be any regular contributions. Some of you guys might put in more money, totally up to you, but I don't think there's any reason to, especially if you're not withdrawing anything out. We're doing this over a period of a year. So from a 1K investment with 10% interest rate every single month over a month, compounded every single month is over a period of a year, we are taking our account from 1K to 3,138,000. And that's the amount of interest that we'll be generating on our account. And that's the sort of percentage that we're going to get in terms of annual growth. So that's 213%. So the reason why 1K actually goes to over 3K is because what is happening is that if you're making 10% of £100 of one K, that's £100. If you're not withdrawing that money, technically now you have £1,100 in your account. If you're doing 10% of 1,000 of £1,100, you are now making an interest of £110. Now, the more you keep doing that every single month, the more the value of your 10% is going to drastically increase. So it's really important to understand, because some people say to themselves, "Oh, what can I do with a £1,000 account?" Well, if you're not withdrawing any money out of it and you're just compounding it and you're leaving it, then you can actually, create some drastic income over a 12-month period. If we done the exact same formula based on a 10K account, based on 10% every single month, and you're not withdrawing any money, from 10 grand, you are now bringing your account to over 30 grand in a period of 12 months. But remember, this only works if you're not withdrawing any money. If you start to withdraw funds from your account, it will mess up your interest and it will mess up your percentages. So if you've got a 10K account, you are now making 10% of 10K, which is 1 grand, and you're withdrawing £500 from that a grand every single month. Of course, you're not going to be ending up with that. So it's really about asking yourself, what goals do you have? What do you want to achieve? And how much do you want to see your account grow? Now, the way to remove or alleviate pressure from yourself is to say, that ideally the original money you deposited, you want to be able to withdraw that money back out of your account within the next couple of months. The moment you can withdraw your money back out of your account, then psychologically, every trade you do, you're going to feel a lot better and you're going to be relieving yourself of a lot more pressure. And that's what I would advise to all of you lot to do. So if any of you guys have deposited a grand, and let's just say you do your compound interest, and for by your seventh month you've got 2,500 in your account, I would then advise you guys to withdraw your grand. Therefore, psychologically, you now know you're not playing with your money anymore, you're playing with the market's money, which means that the decisions that you're going to be taking and the sort of trades that you're going to be opening yourself up to, you're going to be a lot more, your decision making skills is going to be a lot more efficient and a lot more effective. So that's the strategy that I give. But again, is I'm not telling you guys how to handle your money. I'm telling you lot how to really trade, how to understand how the markets work. You handle it how you want to handle it. But the whole point of this sort of example is to let you see that there's a lot of money that you can make if you do compound on your account. So that's the example. So be realistic with it. If you put one grand in your account, it's going to be very hard for you to take 1 grand to 10K in a year. And if any of you lot can take 1 grand to 10K in a year, risking 3%, up to 3% per trade, I'm telling you, any sort of hedge fund or trading firm is going to want to employ you. Like you're going to put yourself in a in a 0.1% of traders, because it's very hard to do that with a 3% risk.
I mean, if you want to talk realistically, then you always think you're gonna make more, but what you will end up losing when you try and make more, I don't think it is really more possible than 10 to like 15%.
Yeah. I mean, some people make more. Okay, I'm going to tell you guys. So I've done 50% in a period of 2 months. 50%. Sometimes I've done 30% in a day. But what did I have to risk to get that? And this is what these. So let me break down the whole facade of what a lot of people see online today. People look at Instagram in particular and TikTok. They see that this person has, I don't know, 10 grand in their trading account. and then they see that person's posting a 5 grand trade. For you to be posting a 5 grand trade in a 10K trading account, I'm not saying everyone's like this, but if I can see that you've not even generated a lot of points, you've probably only generated about 30 points, two things is going to be apparent. One, you're using crazy leverage to even do that, or two, you're risking a unseen amount of percentages of your account to get that as well. That's one of the two things that you're going to be doing. So don't fall into the profits or the money that people are sharing on social media, because a lot of people are cutting corners to get those huge profits. And whilst it may look good now, 10 years from now, it's not going to last forever. Or 9 out of 10 of those people will end up blowing their account by the end of the year. So I would much rather you guys showing smaller profits, but knowing that 5 years from now, you're still here, you're still showing your profits, and your trading account is going to be looking a hell of a lot more kind of enticing than that person's trading account would have looked in a period of 1 to 2 months. So just bear that in mind, don't fall into the facade that a lot of these people are showing on social media, because they're not trading right at all. And I just want to make sure that you lot are trading correctly. So here's a lot size cheat sheet. I'm not going to go too deep into it. So a lot of trading accounts, they do allow you to trade in points, pound per point. But with Vantage in particular, Vantage does a lot of their trades in lots as well. So this is literally just for you to refer back to. So generally speaking, a lot size of one equates to £10 a point. Now, if you've got a 40 point stop loss and you're trading a £1,000 account and you only want to risk 2%, again, as we saw in the previous example, 2% equates to £20 risk. So if you're doing a lot size of one, which equates to £10 a point, technically you're risking, £400, which is 40% of your account. So of course you don't want to do that. A 0.1%, 0.1 lot size is £1 a point. Again, that's £40. If you're only risking 2%, again, like I said to you guys, you can I believe you should be risking up to 3% as you get started, but that would be too much. So this is kind of how it all translates from lot size into money. So be aware of that when you are opening up your Vantage account, when you are trading, just understand exactly how it translates to pounds rather than lot size. As I showed you in the example before, the great thing is that it does show you, so you won't need to do this calculation yourself, but definitely be aware of it. Now, commodities is the exact same thing. One lot equals $10. Oil, same thing. One lot equals a pound. And the same thing with the Dow Jones, US 30, Germany 30, and Nasdaq as well. So refer to that when you've got time, whenever you are looking to go into your trades. And the last thing for this is basically just make sure you are following your trading plan. I think that's the main thing that I really want to stress here, really. So your mind is what really holds everything together, and it's all about making sure that you're never being too emotional or you're never being too impulsive of your trades. Every time you get into your trade, ask yourself, how much am I risking? How much am I due to lose? How much am I due to gain if I do risk what I risk? And always make sure that your ideas or whatever you do choose to do in terms of your actions is always based off your risk, your reward, and your overall exposure to the markets at any given time. So stick to your rules, regardless. Never move your stop loss if something is going against you. So if you do commit to a trade and it's going in minus, if just because you think it's still going to go back up again, don't move your stop loss to a point where you're now risking 15% of your account. Because yes, in some cases it might turn around and go back up again, but what if it continues to go back down? You've now moved your stop from a 3% risk to now 15% risk, which is going to put you in a very bad financial and mental predicament should that go against you. So if you're going to get stopped out at 3%, get stopped out at 3%. But just make sure that you're stopped out knowing that your discipline and your level of consistency is always going to remain the same, whether it's your first trade or your 10th trade from there. And remember, it's just be simple in what you do. It's always about being simple, be simplicity always beats complexity. So the more you keep it structured, the more you're consistent, with making sure you stick to a certain risk in every trade, the better you'll perform in every trade that you'll do going forward from there as well. So that is it. So it's hopefully it's not been too much of a long one today. Like I said, go into the charts when the markets open on Monday, or if you have any time during the week, open up your demo account and just put on a few trades so you can become more accustomed with how things work, because that's how you're going to understand this even more. And then when you do go into your trading view, use those two tools that I showed you, and always ask yourself when you identify a trade, have I placed my stop loss correctly outside of that correction or that structure? And am I being realistic with what I believe I'm going to gain in terms of the rewards for the trade? So get into that habit every single day, and then you'll pick this up really quickly. So that's everything, guys. Is there any questions that any of you guys have? Oh, okay, there's a few questions here. Yeah,
Oh, sorry, Bentley.
yeah.
I don't know, it might be sound like a silly question, but I thought that you see, like with each trade, yeah, that you do, would there be like a list of them that you could look at, be like, all right, cool, now I can see what this trade is doing, or like, um, or will it just still be on the thingy on the just on the normal like trading view screen? Would you just see it there, or would it have like a list, like you have a list in the app on that?
So are you talking about the trades that I do or the trades that you guys do? Sorry.
No, because just in general. So like say like you've got like I don't know, like you said, yeah, you said um obviously you hope that like out of 10 trades or something like that, hopefully like 7 or 8 of them hit. But would you like watch them like one go down and then another go up, or would you just only see it in that trading view bit that you've been showing us?
You'll see in your trading history.
Oh, okay, yeah, yeah, okay, cool.
One thing so this is where journaling comes into play, which is what I'm going
Yeah.
to discuss in the future. Yeah. So you need to journal. So one thing that I used to do when I very first started trading,
Mm,
every single month, I would print off all of my trading history and I'll
mm,
go through every single trade. And then
mm,
basically will allow me to see what was good. And the good thing about Vantage as well, it's got a graph. And the graph shows
mm.
you, kind of your projections and how good you've been doing over a period of time as well. So like
Okay.
if out of 10 every 10 trades you're doing
Yeah.
5 wrong and 5 right, then it's going to show that on the graph. The graph will reveal that on Vantage. And I'll show you those things as well in future lessons. Well, if anyone doesn't have any more questions, I think we're good to go. All right, well, enjoy the rest of your evening, guys. We'll have a good one and we'll catch up soon.